Hello, I'm Jerry Sutherland with eXp Realty. Planning on purchasing a home in 2022, I would strongly encourage you to contact a mortgage lender to be pre-approved for a mortgage loan. Home appreciation will continue in 2022, but not at the same rate that we saw in 2021. Interest rates are slowly inching up, so waiting can only cost you more. My preferred lender is Ted Robinson with Loan Depot. Ted has an online mortgage application website, and I will post that in the video below. If I can answer any questions with regard to a mortgage loan or the home buying process, please contact me. This video is entitled How to be Pre-Approved for a Home Loan. Shopping for a home can be exciting and fun, but serious home buyers need to start the process with at least a pre-qualification letter. A pre-approval letter is best, as most sellers are more willing to negotiate with buyers who prove that they can obtain financing. Potential buyers need to have good credit and show documentation to prove their assets and income, employment verification, and other documentation their lender may require to be pre-approved for a mortgage. Pre-qualification versus pre-approval. A mortgage pre-qualification can be a useful estimate of how much someone can afford to spend on a home, but a pre-approval is much more valuable. A pre-approval means that the lender has checked the buyer's credit and verified the documentation to approve a specific loan amount. An approval letter usually lasts for 60 to 90 days. Potential buyers can benefit in several ways by consulting with a lender and obtaining a pre-approval letter. First, they have the opportunity to discuss loan options and budgeting with the lender. Secondly, the lender will check the buyer's credit and unearth any credit issues. The home buyer will learn the maximum amount that they can borrow. This will help set the price range of the home that they search for. Final loan approval occurs when the buyer has an appraisal done and the loan is applied to a specific property. Here's a detailed look at what you need to know to assemble information and be ready for the pre-approval process. Number 1, good credit. Most lenders require a FICO score of 620 or higher to approve a conventional loan. FHA also requires a credit of 620. FHA guidelines allow approved borrowers with a score of 580 or higher to pay as little as 3.5% down. Those with lower credit scores must make a larger down payment. Lenders with borrowers with low or moderately low credit scores will often work with borrowers to suggest ways to improve their credit score. Number 2, proof of income. Buyers must generally produce the past 2 years of W-2 wage statements, recent paycheck stubs that show income, as well as year-to-date income, proof of additional income such as alimony or bonuses, and 2 years of tax returns. Number 3, debt-to-income ratio, DTI. Your debt-to-income ratio is a strong indicator used by lenders to determine if you have the prerequisite cash flow to qualify for a mortgage. DTI is calculated by taking the total of all your minimum monthly debt payments and dividing it by your gross monthly income. The types of debts that you need to factor into DTI will be reoccurring debts such as credit card statements, student loans, and auto loans. Depending on the mortgage type, type that you're applying for, the DTI a lender is looking for will vary. Typically for a conventional mortgage, a DTI of 50% or less is a benchmark. Many government-backed loans have higher thresholds. Number 4, assets. Lenders want to know that you have some extra money in the bank when you apply for a loan. This assures the lender that you'll still be able to make your payments if you run into financial trouble. This type of account includes any type of account that you can draw cash from. A few examples of asset accounts include savings accounts, retirement accounts, taxable investment accounts. Number 5, property type. Type of property that you buy affects the type of loan you can get. Different types of property change the level of risk for your lender. To buy a small single-family home to use as your primary residence, probably get good terms because lenders know that primary housing costs factor into most people's budgets. Investment properties, on the other hand, take a backseat to primary residences if the owner runs into financial hardship. Balance the potential risks. Lenders will likely require a larger down payment and a higher credit score to qualify for an investment property mortgage. Interest rate, buyer requirements vary depending on the type of property you're after. Keep in mind that not every lender finances every type of property. All your paperwork in order so that you can speed up the process before you apply for a loan. I'm Jerry Sutherland. I'm with eXp Realty. If I can answer any questions in regard to a mortgage, home buying process, please contact me. I look forward to hearing from you. Thank you.